I'm Selina Wang, in for Emily Chang, and this is Bloomberg Technology. Coming up, IBM ends its 22-quarter streak of declining revenue. Its 4Q report card up next. Plus, Amazon narrows its list of top locations to build its second headquarters, with thousands of jobs in billions of dollars at stake. And the fall of Uber's Travis Kalanick was darker than you thought. The details in this week's Bloomberg Business Week. But first to our lead. IBM releases fourth quarter earnings showing revenue growth for the first time since 2011. But shares of the Big Blue are dropping in after-hours trading despite the fact that IBM's new mainframe servers are playing a major role in boosting sales. Investors are anxious as the company faces fierce competition from the likes of Amazon, Google, and Microsoft. Joining us from New York, Arunag Rana, Bloomberg Intelligence analyst. Thanks so much for joining us. So we're seeing revenue finally spike after many years of declines, but shares are trading down. So what's going on here?
I think it has to do with the the margins. I think there was a year-over-year decline in it. I think investors might be looking at some improvement over there. As far as the revenue increase is concerned, this was pretty much baked in. We knew that the fourth quarter numbers are going to be strong because of the mainframe refresh cycle. The question is whether they can sustain this momentum throughout next year, and I think we'll learn about that on the conference call, which is starting soon.
So IBM has really placed its bets into these newer lines of businesses like cloud computing, artificial intelligence. Have they proved that this is paying off yet?
See, the cloud numbers were better, and so were the strategic imperatives. Both of those showed an upward trajectory. And that is, that's a very good sign. But as I've said it in the past, that the legacy business is still a very large portion of IBM's business and is dragging down overall growth rate. They really have to perhaps do an acquisition or two to accelerate that momentum even more. What we are also seeing is improved tech spending from global enterprises, and that should help that emerging technology portfolio also in 2018.
What does this mean for IBM's long-term trajectory? Does one bright quarter mean anything in this greater turnaround?
They need to have a lot of these, quarters with positive growth rates, and in almost every quarter, I would want them to have, a slight improvement in the growth rates. Because if you were to look at it, IBM is trying to position itself as a cloud company, as a software company, and software spending is somewhere around 7-8%. So we still have a long way to go from a 0 to 1% constant currency growth rate to a 7 and 8%. So it has to be a very gradual process.
And what's investor outlook right now in terms of this turnaround strategy that's going on here at large? Is there a lot of skepticism? Is there hope that this could actually improve?
I think I would say the playing field is somewhat even at this point. There have been a lot of skeptics over the last 5-7 years. Last 1 year, we have seen a lot of analyst upgrades in the name as the growth rate has come back from negative to 0 to 1%. And we just have to see whether they can maintain this space.
All right. Thank you, Anurag Ran of Bloomberg Intelligence. Off to next time. Now, another top story we're watching. Amazon has narrowed its field for HQ2, its proposed second headquarters in the U.S. 20 cities made the cut, among them New York, Boston, Chicago, Miami, and Austin. The project's expected to cost $5 billion and create 50,000 jobs. Joining us from Seattle, Bloomberg's technology Spencer Soper, who covers all things Amazon, and here with us on set, Intello CEO John Bisky. Intello applies big intelligence to big data to help modern recruiters find, qualify, and acquire talent. So Spencer, I want to start off with you. If you take a look at a map of the locations that they've narrowed it down to on #BTV8529, there seems to be a strong concentration on the East Coast and South. And I also noticed that there were about 3 bids from the Washington, D.C. area. So are there any surprises or standouts from what we've heard?
Yeah, there's definitely a big presence on the East Coast and Southeast, and also just the big major metro areas with the biggest labor pools are standing out. I wouldn't read too much into the 3 areas around D.C. because Amazon is likely targeting labor pools, and sometimes and those very often cross geographic lines. So even though that could simply be Amazon focusing on that general area, but it has to negotiate with different political groups because of just geographic boundaries.
John, I know your firm Intello has really been digging into the biggest tech hubs in the country. So what did you find, and did many of them line up with what Amazon has released?
Yeah, we looked at a lot of our data, which we have data on almost 500 million people in terms of their skills and their capabilities. And what you find is that a lot of the bigger cities like New York and Los Angeles tend to have the most candidates to pull from. But I also think when you look at the list, you've got a lot of proximity to universities. So for example, Pittsburgh being proximate to Carnegie Mellon, if you're looking for technology talent, that would be a relevant factor in the equation.
And Amazon also received proposals from hundreds of locations. So what is that process that they took to really narrow that down?
Well, a lot of what they're thinking about as one of the world's fastest growing companies is what will happen in the next 10, 20, 30 years. So where do people increasingly want to live? They're going to factor in things like public transportation, cost of living, but I think it really breaks down at the end of the day to talent. And can they find enough talent in that location? Do people want to live there? What will the quality of life ultimately be?
And Spencer, what characteristics do you think Amazon is really looking for here? We have a city ranging from New York to even suburbs like Montgomery County.
Yeah, I think the main thing is going to be size of labor pool and the right type of talent in that labor pool. Amazon churns through people. People typically last about 3 years or so at Amazon. So if you're talking about 50,000 employees, you have to account for churn and attrition through that 50,000. They need a big talent pool to draw from.
Spencer makes a great point there. I mean, what will it take to attract people to this city that they choose, and where are they going to come from? Are they going to be Silicon Valley transplants, organically grown?
Well, I think this is why education and the university system are so important. You have so many people who are growing up in other parts of the country, and when they look at cost of living and they look at their hometown, they'd love to stay if there were enough jobs. And where you see a lot of people gravitate to the Bay Area or other more urban areas is because they perceive that their own hometown does not have the economic opportunity. So were Amazon to base HQ2 in a smaller city relative to some of the larger cities on the list, it would be a bet to say we're going to be able to keep the talent that is in that area there versus watching that talent leave and go to other places. One other thing I think that will factor into this is Amazon's focus on a diverse workforce. And so if you think about where there might be greater pools of diverse candidates, I think that will factor into the equation as well.
Now, Spencer, Amazon has received huge tax breaks to build its delivery and warehouse systems across the country. So what sorts of benefits do you expect them to get for this new headquarters?
Well, if you think about the warehouse jobs, those are generally lower skilled and lower paying. So it's going to be easier for politicians trying to lure Amazon to justify even better deals. And this is huge. 50,000 jobs, total compensation, including benefits, in the $100,000 range. So these are a big, big economic impact. So whatever you saw for the warehouses, you can expect to see that and much more so for the headquarters operation, which is trained professionals earning good salaries and buying homes and a good economic ripple effect through that entire economy.
And John, speaking of the economic impact, Amazon has obviously completely transformed Seattle, brought great economic wealth, as well as some strains on the infrastructure and rising prices. So, I mean, what do you think this ultimately means for the chosen city?
Well, I think it's huge because not only do you have the commitment that Amazon has made, like Spencer was saying, 50,000 relatively high-paying jobs, but then it's the follow-on effect. So Amazon will base their next headquarters there. You'll bring in other companies, other innovation. It may be more appealing now to live there, to go to school there. So I think it's huge. I think it's why you've seen so many mayors in so many of these cities go to great lengths to try to attract Amazon. They recognize that there are not 100 Amazons in the world right now. It's a much smaller number of companies that could have this sort of an impact on a specific region.
Fascinating stuff. Well, Jan Intello, CEO, thank you so much for joining us, as well as Bloomberg Technology's Spencer Soper. Coming up, the battle to say net neutrality is seeing U.S. states take legal action. We talked to one of the state attorney generals leading that effort. Up next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, weekdays at 5 p.m. in New York, 2 p.m. in San Francisco. This is Bloomberg. Qualcomm has won EU approval for its bid to take over rival chipmaker NXP. To secure this conditional approval, Qualcomm said it won't buy some NXP near-field communication patents. It will also maintain certain licensing terms for NXP technology. Now, a side effect of the deal may make it harder for Broadcom to push through its $105 billion takeover bid for Qualcomm. Now, the fight for net neutrality is heating up. A coalition of more than 20 attorney generals are suing the FCC over its decision to roll back the Obama-era internet protections. One of the attorney generals leading that charge is California AG Javier Becerra, and he spoke to Bloomberg TV earlier today about what's at stake.
Well, it's the beginning of what I hope is a fight that we can win, because if we can't, then that means a lot of people in this country will no longer have access to that internet the way they've expected it. We all want choices. We want the freedom to choose. And if you get rid of net neutrality, all of a sudden you go towards a system where the haves will have it all and those who are hardworking will get very little.
Now, what about the idea that the president just signed an executive order to make it easier for companies to put broadband in rural areas? Is that taking the sting out of the tail a little bit?
It won't work. Because why would a company invest money in a rural area where you can't make that much money, there aren't too many people, instead of going into the higher income areas of the country or the densely populated areas of the country? That's exactly why you need to have net neutrality, so there's no gaming of the system by the providers of the service. Think in terms of water, or even education, electricity. We don't tell companies that get to dispense water or electricity, or the places that get to provide education for our kids, you decide where you want to go based on money. We know where they'll go, where there's money, and they'll leave everyone else behind. Think in terms of old mail service. In the rural areas, there would have been no mail service had it been based on money.
Mr. Attorney General, what can you do more than this lawsuit to actually try to fight this rollback of net neutrality? For example, is it possible for you to take a case against an internet service provider that might be discriminating by providing a lower speed service to some of its customers? Can you do that?
We could continue to enforce our state laws. We could make sure that a company is not discriminating against communities. And we can work with our state legislature and our governor to make sure that we pass whatever laws we can in our state to make sure we have a robust regime of protections for consumers. And we are moving in all of those fronts, because this is about not only providing people with choice and freedom to choose, but it's also about keeping California's economy moving forward. We're the economic engine for the country. We're the 6th largest economy now in the world. Why would we want anyone to disrupt that?
Who has been a bigger opponent of the FCC chairman's policies, would you say, the entertainment industry or the tech industry?
Both. They both understand the consequences of not having that access for consumers. If the choice is made by those who have money, who wield power, then those in the middle class, are the biggest losers, because they don't have the financial leverage to try to attract the business their way, and they'll be left with the crumbs. You'll have different speeds of internet service. You'll have different choices in the types of media that you can look at or watch. Your kids, can you imagine your kids if they use the internet to do their homework? There will be kids who have access to everything they need on the internet to do good work and excel in school. There will be vast numbers of kids whose parents can't afford that, and therefore they're going to be behind.
Are you in conversation at all with any internet service providers in the state of California? Have you notified them that this will be the action you'll be taking?
I've been working with a number of the internet service providers and those in the internet community overall for more than, for the last year that I've been the Attorney General, because California has been moving to try to do what it can to make sure that we move forward protecting our consumers before this action by the FCC. So we'll continue that conversation because we want our internet service providers, our companies here, to thrive. California is the innovator when it comes to the United States of America. We want companies to locate in California. We want them to know that the innovation occurs here. We're ground zero for innovation. But we want people to know we want to do it for everyone.
That was California Attorney General Xavier Becerra speaking with Bloomberg on the battle to restore net neutrality. Coming up, an app that will allow you to save and invest your spare change. We'll tell you all about Acorns Grow up next. This is Bloomberg. Financial technology startups are grabbing a greater share of capital from investors. The Rise Fund, a private investment fund co-founded by TPG's Bill Glashan and U2's Bono, is making its first known bet on a fintech business by backing Acorns Grow. Now, Acorns offers an investing and savings app tailored to people with small amounts of disposable income. About 2.7 million people use the app to put spare cash into exchange-traded funds managed by Vanguard Group, BlackRock, and others. Joining us now from New York, Acorns CEO Noah Kerner. Noah, so your company's already racked up millions of customers. So how does the app exactly work, and what's your target demographic?
Yeah, so thanks for having me. So Acorns makes it effortless to invest spare change, and the spare change goes into an exchange-traded funds in a simple portfolio. When you sign up, you link your bank account, you link your credit cards or debit cards, and every time you make a purchase, whether you buy a cappuccino at Starbucks for $3.50, we round up the purchase to the nearest dollar and invest the spare change into the portfolio for you automatically.
So if many people are using this to invest, maybe a few cents here, a few dollars there, I mean, what is the average investment size that they place in Acorns?
Yeah, so it's really easy to invest $50 to $60 a month. Just from the Roundup feature, you can invest $30 to $35 a month. And then we also have an automated recurring investment where you can make an investment by the day, week, or month. So $5 a week, let's say, and that gets added into the same portfolio. So it makes it really simple to add up.
But even if you're setting up this sort of recurring payment structure, it's still a very small amount compared to a lot of the larger robo-advisors, digital investment platforms. So what's the plan to get profitable? Are there higher margin products in the works?
Yeah, so it's a good question. I mean, so our customers across America tend to be under $100,000 household income, and we have a simple business model. We have a subscription service, so you pay a small monthly fee, and we also have a program called Found Money, where we've partnered with 150 brands from Nike to Zappos to Airbnb. Those brands invest into our customers' accounts when you shop with them, and we make money that way too. So again, it's a subscription service, subscription business model, and we make money from brand partnerships. So we think it's a really nice model, and one of the things we're really passionate about is building a business that does well by doing good.
Now, there's also a growing number of startups in this space and digital wealth management, also targeting more beginner investors like Acorns. So what makes your company different?
So a couple things. I mean, first of all, we make it really easy to get going, right? And one of the things from a customer's perspective, because of roundups and because of automatic recurring investments, one of the things that happens is you're investing really frequently, and you come back and you constantly see that investment amount add up. So you see $7 and $15 and $25, and you start to get that kind of encouragement and confidence that you can be a saver and investor. And in large part, we're talking a lot about people who haven't invested before. We've got people investing at 18, 19, 20, 21 who might have started investing in their 30s or may never have started investing. So that's one thing. The other thing is we connect spending with investing. And so like I was saying, with our Roundup feature, when you go about your day and you're making purchases, we make sure you're also investing when you make those purchases. And with our Found Money program, we partner with brands, like I mentioned before. When you shop with those brands, they invest into your Acorns account as a reward for shopping. So we're helping you collect money in various ways. We also focus really intensely on financial education. So we have a publication called Grow, led by the former personal finance editor from CNBC. And all that educational information is there for you while you're making decisions inside the product. So those are some of the things that, that make us different.
And I want to touch on your fascinating investor list. You've attracted many celebrities, including Bono, Ashton Kutcher, Kevin Durant. So how are you pitching yourself to them? Why are they getting on board?
So it's a similar thing. I mean, our business model is simple. I think our investors like Bain and PayPal, TPG and their Rise fund that just made that latest investment, I think they get really excited that we've got a good business that does well by doing good. So we're building a product that helps Americans that are underserved. We believe in financial inclusion, and we have a business model that's fair for our customers, but also allows us to build a strong business.
Well, Noah Kerner, ACORNS CEO, thank you so much for taking the time and joining us. Now, coming up, Travis Kalanick's downward spiral at Uber. New details of his departure from the ride-hailing giant. This is Bloomberg. This is Bloomberg Technology. I'm Selina Wang, in for Emily Chang. Now back to our top story of the day. Amazon has narrowed its list of 238 potential locations for its second headquarters down to just 20. Now among the top contenders, New York, Boston, Chicago, Miami, and Toronto. The project is expected to cost $5 billion and create 50,000 jobs. Joining us now by phone is Ron Josie, an analyst who covers Amazon at JMP Securities. Now, Ron, Amazon is really breaking away with this public spectacle from its very secretive methods of expansion. Why do you think that is? Does this have anything to do with trying to boost its profile under Trump's agenda?
Hi, Selina. Thanks for having me. I think it has everything to do with them just highlighting how important they have become to the overall economy and the marketplace, and how they're sort of driving a lot of the innovation that's happening both in online and offline retail. I mean, you're exactly right. You know, the $5 billion they expect to spend, the 50,000 high-paying jobs. It's wild, though, as you go on and read the press release. They have 540,000 employees worldwide, and so they are certainly not small by any means. And so this is an important thing for them. It's going to be an equal in terms of stature, their Seattle headquarters, and so it's a big deal for them. And I think it's just another example of how important they are to the broader sort of ecosystem of commerce and the economy.
Now, I want to shift gears a little bit to their new ventures. Jeff Bezos has famously sacrificed profits for growth, and Bloomberg News is now reporting that they've been quietly building this marketing platform. Do you think this could move the needle in terms of profitability for them?
Yeah, I know. I mean, when you think about 2018 and some of the key trends at Amazon specifically, I mean, of course, we talked about the new headquarters, and of course you have Whole Foods integration offline to online, but online advertising and just building up a marketplace. I think it was the question around online advertising. You know, it absolutely would be a needle mover in terms of profitability overall. Maybe not so much in terms of revenue, but in terms of profitability. I mean, if we just look to see margins at Facebook, at Google, and other online advertising marketplaces at size and at scale, you know, you're talking about maybe contribution margins of 75–80%, and you bring that over to Amazon, then that can be a big driver of profitability. And even taking a step back, Selina, you think about the core businesses at Amazon, the retail business, the AWS business, and now maybe even advertising. AWS and advertising are very high margin businesses that can likely subsidize even more their e-commerce and their commerce initiatives.
And if Amazon does successfully build out this marketing platform, do you think it could somewhat break up the duopoly between Facebook and Google and digital advertising?
I think it'd be hard to break up. I think for sure there's the constant sort of offline to online secular shift that's happening. And one of the benefits that Google and Facebook and even Amazon have, and many of these properties at scale, is just the amount of knowledge and ability to target a user, something that you just can't really do as effectively offline. And so, I don't think that Amazon entering the fray would significantly impact Google search to a certain degree. I mean, at the end of the day, search remains a very key part of most advertising campaigns. But I think what it would do is impact traditional media and where ads might be originally focused or, earmarked towards offline uses like TV or print might get reallocated over to Amazon. And so, I think Facebook and Google have solidified themselves as must-buy advertising networks, and I think Amazon has the opportunity to do that, and they're hiring and building a tech stack to enable that. So I don't know if it impacts Google. I don't believe it impacts Google and Facebook. If anything, it makes the pie larger for online advertising that's growing, 20% on average for the last several years, which is impressive.
Well, we'll just have to check back in with you in a few months on that. Yeah. Ron Josie of JMP Securities, thanks for joining. Now, from investor lawsuits and federal investigations to mass resignations, 2017 was a rough one for Uber. But before all of the crises that hit the startup, it also had a critical problem in its foundation, now former CEO Travis Kalanick. The latest edition of Bloomberg Business Week provides the inside story of Uber's hard year and the fall of Travis Kalanick. Bloomberg's technology reporter Eric Newcomer wrote this week's cover story and joins us now. Eric, this was a fantastic story. It was much darker than I had anticipated. From the PR crises to the internal turmoil.
Right.
So give us the rundown of the really new scoops that you got out of this in your reporting.
I mean, really, we tried to take people behind the scenes. So it's, we published the driver video in February where Travis Kalanick is arguing with the driver. As it turns out, he was actually in a meeting with top executives discussing Uber's toxic brand. Basically, Uber had found that people had a pretty good impression of Uber if they'd never heard of Travis Kalanick. If they had, they had a decidedly negative view. And so it's during that meeting that he sees the video and he gets pulled out and he's sort of on the floor squirming and saying, this is bad, I'm terrible. And it was just sort of a jarring moment for executives where it really felt like, he's sort of central to the company's image problems.
And we aired that tape on this show, actually. And you also had this really interesting detail about the new CEO, DARA, and when Travis first interviewed him in Seattle, and DARA came out of that meeting saying, wow, it seems like Travis is still very much in charge. So what's the situation now? How has he distanced himself?
Right, because there was this whole period where an executive committee was supposed to be running the company, but Travis, was out helping to recruit the new CEO, and he was still calling into some meetings and at one point even talking about a potential shareholder vote and sort of whip counting to see what sort of support he had. So I think that's really pared back. I mean, Travis offered up 50% of his shares as part of the SoftBank deal. He got to sell 29%. Today, he should be a real billionaire, no longer just a paper billionaire. The wires are going out. He sold $1.4 billion. So I think now he's sort of really stepping away. DARA is really taking up all the oxygen. So it's not like that anymore. It's DARA KHOSROWSHAHI'S company.
And it sounds like from your story that he's doing all of the right things. I mean, what is his turnaround strategy exactly?
I think it's that, maybe Uber needed to be the rule-breaking company to sort of break through the taxi industry, but now it's the incumbent. So it's going and sort of striking agreements with London and Brazil and apologizing. It's a lot of apologizing and also disclosing past actions. DARA sort of talked about this hack of 57 million accounts proactively before the press was onto it. And so I think it's a lot of right now apologizing, owning Uber's mistakes, and and then just moving forward.
You also had some fascinating detail on Arianna Huffington, who was portrayed as a sort of proxy for Uber, a big ally of his, and she had a constant presence at the company from what you wrote.
Right. I mean, Arianna Huffington was super close to Travis Kalanick. She was for a long time seen as his loyalist. I mean, I don't think we put this in the story, but I mean, she was with Travis in Fresno when his mother died in a tragic boating accident. So they were very close. And she played a very active role at the company, to sort of some mixed reviews, and also bringing her expertise from Thrive to Uber.
Wow, fascinating stuff. I'm looking forward to your next cover story. Bloomberg Technology's Eric Newcomer.
Thank you.
Meanwhile, Uber has officially completed its highly anticipated deal with SoftBank. Shareholders sold about $8 billion of stock at a valuation of about $54 billion, a heavily discounted price. This deal puts into effect changes to the company's board and stock that were contingent on the transaction going through. Uber will create additional board seats, expanding the total to 17. Coming up, why one company made the pivot from trading Bitcoin to handling cryptocurrency payments. We'll speak to the CEO of Circle Internet next. This is Bloomberg. U.S. taxpayers may end up paying for the missing government satellite launched by Elon Musk's SpaceX. The satellite came off a SpaceX rocket and crashed into the ocean earlier this month. Industry experts don't think SpaceX or satellite builder Northrop Grumman will bear the cost because they probably have government contracts that limit their liabilities tied to the lost satellite. Now let's turn to the cryptocurrency market. The roller coaster in prices we've seen at the start of 2018 eased on Thursday as Bitcoin held on to gains above the $10,000 level. Rivals Ethereum and Litecoin both rose more than 5%, while Ripple jumped 26%. But this kind of volatility calls for more regulation around the globe, and it's making investors question if there's really opportunity in the market. Joining us now is Jeremy Allaire, the CEO of Circle Finance, a company that helps customers instantly send digital currency payments, and he joins us now from Boston. Jeremy, I want to start out with the fall in value of Bitcoin, Ripple, Ethereum, and the rising regulation. I mean, which of these currencies do you actually think is going to have utility and staying power moving forward?
Yeah, thanks, Selina. You know, I think if you've been in this market for a while, 4 or 5 years, 20% moves are pretty normal in this market. And so I think, obviously, if you're in the public stock market, 20% moves are more significant. But this is a market that has been highly characterized by volatility really since inception. And, obviously you need to kind of pull back a little bit and look at the chart over a week, over a month, over a year, over 5 years to get a bigger picture of the kind of what's happening with these assets and how they're growing in value. A lot of things going on, obviously, on the regulatory side. This is really a market that's maturing. 4 years ago, there were no regulations. This was complete Wild West. There were no serious exchanges. We now are in a world where this is regulated in the United States by multiple regulators. Mainstream investors are involved in it. There's more and more retail products. And that's now expanding into other markets like Japan, who've embraced this. It's one of the biggest markets in the world. They embraced it by regulating it. And so regulation isn't necessarily a bad thing. It's actually a good thing. It means consumers are protected. It means that investors are protected. It means that there's, not market manipulation. There's market structure that makes sense. And so, if anything, regulatory engagement is a positive. And I think when people step back from this, they generally see that. And I think that partly explains the the kind of rebound that we've seen over the past 36 hours.
Now, Circle has made some interesting changes to the business. You actually stopped servicing direct consumer Bitcoin trades and now are focused on digital payments and over-the-counter trading. Why make that pivot?
Yeah, so we didn't make a pivot. When we started the company, the vision was consumers should be able to send and receive money the same way that we share content and media and data on the internet. And we wanted to build that on top of cryptocurrency technology because we thought that was the foundation of how money would be stored and transmitted globally. And that's what we did. We built up a system around that. People in that payment product were using it to also essentially buy and sell Bitcoin. That was sort of the system was set up so it allowed for that. That really wasn't the center, the design center of the product. Circle Pay is for free social payments that work around the world, that work whether you're in dollars or euros or pounds, and through the blockchain can connect to lots of currencies around the world. You can think of it as more of like a crypto-powered alternative to something like a Venmo or a Square, but that works in more places around the world. Behind the scenes in building that, though, we continue to build out our crypto trading operation that supports that and allows us to make that a free product. And that's really grown. That's Circle Trade, and Circle Trade is one of the largest, if not the largest, OTC trading and market making platforms in the world for crypto. And we trade billions of dollars a month in crypto, and it's a very, very significant business for us.
That's fascinating that it's become such a large part of your business, but as more institutions like Goldman Sachs, as we've reported, looks to get into this business of market making and providing liquidity to institutions for these cryptocurrencies, I mean, what is the impact of that on your business?
Yeah, so I mean, we kind of look at it a few ways. So the first is, obviously, if we see this go from the volumes that we see today to 10 or 20 or 50 times the volumes that we see today, obviously that's a great opportunity for a lot of players to be in the market. There's not one broker dealer in the world, for example. These markets are made globally with trillions of dollars from lots of different players. We're in a really strong position in this space, in part because we have the fuel of consumer products, and that's actually a key piece, which is we've teased a little bit about this publicly, but we have a new product that's coming out soon called Circle Invest, and that really aims to make crypto investing as easy as investing in a mutual fund or in your 401k, and do that simple, fast, instantly with the best economics in the world. Circle Trade allows us to power that in some respects, and what we've been able to build out on the consumer side with Circle Pay as well. So, we're going to have a family of consumer products and this OTC business, and that's a pretty strong and differentiated position in the market.
And in 30 seconds, what are those consumer investment products going to look like? I noticed you recently acquired mobile investing platform Trigger Finance.
Yeah, so the Trigger Finance team actually is part of the leadership in building Circle Invest. And Circle Invest will be a mobile-first experience. If you go to invest.circle.com, you can see a little bit of a teaser about it. We like to say it's crypto without the cryptic. It's really optimized around a user experience on mobile, which lets you sort of see a portfolio of assets, balance those, look at kind of the return on the investment of those assets over time, and do that with instant liquidity and with the best economics in the world, with multiple types of coins and assets.
I'm looking forward to our next conversation. Jeremy Allaire, the CEO of Circle, thank you for joining us.
Thanks, Selina.
Coming up, with its new radio and podcast offerings, Spotify is going head-to-head with Apple. Is the streaming service ready to go up against the tech giants as it prepares for an IPO? This is Bloomberg. As Spotify preps for its IPO, it's working on new ways to lure listeners away from rival Apple and gain footing in the radio and podcast space. The new initiative is called Spotlight. Now for more, we're joined by Bloomberg News' Lucas Shaw in Los Angeles. Lucas, how much of this is a selling point to investors right ahead of the IPO?
Well, Spotify has tried very hard to convince people that its profit margins are going to improve, because the big challenge for them, as successful as they've been in creating this market for on-demand music and really lifting the record industry up after several years of decline, the company itself is not profitable because it pays out so much to rights holders. And all these other types of programming, whether it's news or culture, podcasts, video, are ones where if they're successful in them, they can bring in new customers, maybe sell some ads, and they don't have to spend as much, and it will improve the margin picture, which is of a big concern both for kind of the current investors and for future shareholders.
Right, the cost of music rights is incredibly high. Spotify has been steadily diversifying. So what are some of the other projects they've been working on, and how successful have they been?
It's been mixed. You know, for the past few years, they've dabbled in video and then forms of audio that aren't music. So they initially hosted videos from media companies like Vice and ESPN. Then they funded original video series. None of the video projects really worked, and the executives there are pretty aware of that. Podcasting holds more promise. They've had some uptake with some of the big podcasts like the New York Times, The Daily, and now Spotlight is trying to fuse these two ideas together where you take audio and enhance it a little bit with some visual elements, because I think Spotify has come to the conclusion that having original video and trying to compete head-to-head in that way with YouTube won't work. But if they can take their kind of the thing that people come there to do, which is listen to audio, and make it a little better, then that can work, and maybe they can sell ads at a higher rate because there's a visual element to it.
But what do you think consumer adoption will be like for news and political coverage on Spotify? I mean, there's already huge competition, as you mentioned, coming from Apple and Google.
I think there's huge potential for it, because if you think about someone, I mean, I just think about it personally. On my way to work, I tend to toggle between listening to podcasts, listening to music, and listening to the radio. And switching from the podcast app to Spotify for listening to music is kind of a hassle. So if they can deliver podcasts and news in a way where I can do that in the same app where I'm listening to music, that's a behavior that is kind of replicable for a lot of different people. But they do have a lot of competition, and they do have to get the word out there that if you want to listen to podcasts, which is a growing medium, you can do so on Spotify, and you don't have to do so using the Apple app, which is still the market leader and accounts for 50 or 60% of all podcast listening.
Well, I'll certainly be keeping an eye out for Spotlight. Thank you, Bloomberg's Lucas Shaw. Now, that does it for this edition of Bloomberg Technology. A reminder that we are live streaming on Twitter. Check us out at Technology, weekdays at 5 p.m. in New York, 2 p.m. in San Francisco. That's all for now. This is Bloomberg.